Hello everyone. Today I'm going to talk about becoming tax efficient in income tax, capital gains tax and inheritance tax. I need you to remember the next two principles. Firstly, never ever sell your investment property. And secondly, as the property goes up in value, increase your debt against it. Now, a lot of people will listen to that and get a little bit anxious or worried about the thought of increasing their debt on their investment property. But I hope to alleviate those concerns as we go through these slides and show you that to become tax efficient, it is vital to continue to increase your debt against the value of your property. Let's talk about debt and the difference between bad and good debt. I'm sure if I asked the question, if anyone was brought up thinking that debt was bad and that saving money was good, a lot of you would agree to that statement. Now, I certainly was. But to stay current in this market and to stay tax efficient, we need to know the difference between bad and good debt. Bad debt is a debt you have to pay whether you use something or not. So good examples of that would be your car or the home that you live in. Good debt, on the other hand, is a debt that someone else is paying and not you. And you're also making money on it. Richard Branson has a written goal which states, "I want to be one of the first people to die with a personal debt of £1 billion or more." Wow. If you consider that statement by Richard, what type of debt would you like to have? Because I bet you he's making a lot more money on his debt than 1 billion. Let's look at the first tax and how to become income tax efficient. And for clarity, the following examples do not take into effect any tax deductions. By that I mean, if you're a 40% taxpayer, you'll pay 40% tax. If you're a 20% taxpayer, you'll pay 20% tax. And it also doesn't take into consideration the government ruling on Section 24. For the following examples, let's imagine we've got two identical people, person A and person B. And by identical, I mean they bought the same property in the same street for the same amount of money. So person A has bought this property for £90,000. He's managed to secure a 75% loan to value on the property and has a mortgage of £67,500. It's an investment property and he's renting that property out for £650 a month. The mortgage, which is an interest-only mortgage, and person A will have probably taken this mortgage out for 15-20 years, thereabouts, and let's imagine he's paying £253 per month on this mortgage. He has maintenance that he puts away at £80 a month, buildings insurance £20 a month, and he's got letting agent fees at £78 a month. So the net income is £219 every month for the next 15 or 20 years or however long he's got that mortgage going on for. Let's have a look at person B. Has also bought a similar property at 90,000, managed to secure a loan to value of 75% and has a mortgage of £67,500. Person B has also rented out his investment property, but over the years has decided, well, look, instead of paying my interest only, what I'm going to do is I'm going to pay it off, because I've been brought up with the belief that debt is bad. So if I pay that debt off, if I pay my mortgage down to zero, instead of me spending £253 every month paying the mortgage, I can actually add that onto my top line. And the thinking behind it is I'll be better off. I've got more cash in my pocket, so to speak, and I have more money to spend. But let's see what HMRC like to do about this. You're now earning more money, so you will now be taxed more. So originally he was earning £219 a month. The mortgage literally drops onto that because it's paid off, so it's additional money of £253. He's now got £472 coming in as profit per month. As a 40% taxpayer, he will have an increased tax bill of £1,214. Let's look at the final slide on how to become income tax efficient. Person A was happy to have his interest-only mortgage paid for him. Remember, that was a good debt, and a good debt was something which is paid by someone else and it makes you money. Person A had rented out his investment property at £650 originally, and he had his mortgage payment of £253. He had his maintenance, building insurance and letting agent fees to take off that, but he was still making a profit of £219 way back at the start. A number of years have passed, and as the years go by, you should be increasing your rent between 3 to 5% per year. Okay, inflation takes hold, so you should put a little bit more away for maintenance. Building insurance could increase, and letting agent fees could increase. In this example, I've kept it the same. Be aware that on average, the house prices in the UK increase by about 7.9% per year. Person A would turn around after a number of years and refinance his property. The mortgage lender will probably turn around and say, well, how are you going to pay for this added increase on your mortgage? Because it'll be a bigger mortgage. And person A will turn around and say, not to worry, I've increased my rents year on year out to cover any increases in my mortgage or when I come to refinance, as I'm doing just now. So what therefore happens? Your net income actually stays the same. Your income tax therefore remains the same. And why is this? It's because of that rule number 2 right at the beginning. You've increased your debt as the property value has increased. Makes sense now, doesn't it? Anyway, that concludes what I had to say about income tax efficiency. So I hope that's made sense, and I look forward to going on to the next slide. Let's have a look at the second tax and how to become capital gains tax efficient. In this example, we're buying a property at £100,000, and as the fact says up there, on average house prices double every 8 years in the United Kingdom. But let's be conservative. Let's say 15 years. So your £100,000 house has increased to £200,000. In another 15 years, it's now increased to £400,000. Person B, if you remember, was the person who grew up thinking that debt was bad and has come to retirement and has decided to sell his investment property of £400,000. So after 30 years, he sells his house and he makes a gain of £300,000. Now, if person A was a 40% taxpayer, he'd be charged 28% capital gains tax. That's £84,000, leaving him from his £300,000 gain £216,000. Now, if you were a 20% taxpayer, you're charged at 18% capital gains. Still a lot of money. Person A, on the other hand, remembers the first 2 points of, firstly, never ever sell your investment property, and secondly, increase the debt against your property as the property value increases. He therefore takes out a mortgage. He refinances his property at 75% loan to value and gains £300,000. The difference between person A and person B, well, person A still owns the property, still has it, and hopefully will continue to make money from that property even after his death. Person B, on the other hand, has lost his property, but has made some money and will hopefully have a good time spending it. The other thing to remember as well is that when you refinance your property, any money left over after you've paid your solicitor fees, with conveyancing, etc., is tax-free money. And for simplicity reasons, I'm not showing all these deductions coming off on these examples. So £300,000 for person A is tax-free money. Another point to remember, which really reflects back to never ever selling your investment property, is something known as capital gains tax washout. That if you die, your inherited properties will not be taxed by capital gains at all. If you sell your property though, you are taxed. But if you pass away, your properties are therefore never ever taxed by capital gains tax. Another very good point to remember. And I hope that sort of gives you a little bit more clarity on how to become capital gains efficient. Let's have a look at the last tax and how to become inheritance tax efficient. When you pass away, the first £325,000 is tax-free. And as a couple, when you're married, it's £650,000. Your inheritance tax is usually worked out on the size of your estate. So for this example, let's say that your estate is your residential property, the cars you might own, any stocks or bonds, and any other valuables that have managed to be sold. And that comes to either the 325,000 and 650,000. And therefore, for clarity, your property portfolio is still sitting outside of this inheritance tax bubble, and it's sat there worth £1 million, for example purposes only. If you remember back to person B, who believed that debt was bad and therefore didn't follow any of the rules of how to become tax efficient, on his death he would end up paying an inheritance tax of 40% on his £1 million property portfolio, which is £400,000. Person A, on the other hand, who was financially savvy and followed the tax efficiency rules, increased his debt against his property value. Again, he has a very similar property value of £1 million, and his debt therefore is £750,000 if he'd been concurrently taking out 75% loan to values. Inheritance tax is worked out on the equity. You can't tax a debt, or so it's worked out on the equity of £250,000. So his inheritance tax bill of 40% would be worked out as £100,000. A remarkable difference compared to person B, who is paying £400,000. I hope that clarifies inheritance tax efficiency for you. And I hope you always remember the first two rules on becoming tax efficient. Never ever sell your investment property. And secondly, increase the debt against your property as the property value increases. I really hope you've enjoyed the slideshow on tax efficiency. And with the small amount of knowledge I've passed on, I hope this will enable you to become more tax efficient in inheritance tax, capital gains tax, and income tax. Thanks for watching, and I'll see you again soon.